Hello students, so welcome to the today's session. There was a lot of disturbance today in terms of lights getting, power offs, and then some kind of a network issue which was there, and hence starting a bit late. So let's begin with module 5, the chapter number 5 of the modules. I am referring to the study material provided by the institute again. So today we'll take up the financial statement analysis, that is the 5th chapter. So let's understand the financial statement analysis per se, and you as and we as management accountants typically must have been dealing into various ratios, etc. So all that, and going through the various financial statements also from time to time for various purposes. So let's understand the financial statement in a different perspective and analyze it and the importance of such analysis. So begin with, there is a 6-step financial statement analysis framework. Now the first step is to state the objective and context. Why exactly, what is the purpose of doing the financial statement analysis? That's the underlying objective and context setting. So identify key questions to answer, decide the format, available resources identify, and time frame or within which time frame that you need to do and complete the task of financial statement analysis. So first step is stating the objective and the context of FSA. Second is gathering the data. Now in gathering the data, typically obtain the financial statements of the company or the organization which you are in a way doing the analysis of. So obtain the financial statement, because ultimately this topic is all about analysis of financial statements. So obtain the financial statement. Collect, because we need to look into the particular business organization in the context of the industry and the overall economy also, and hence collect the industry and economy data. And third will be conduct qualitative research of the business organization, for example the management, suppliers, customers, site visits, etc. So these are the softer points of research that one has to do. So that's gathering the data, qualitative and quantitative. Third step will be then processing the data. So adjust the financial statements if needed. So adjustment of financial statements means reinstating or regrouping the financial statements if at all there are certain divergent or divergences between the two accounting periods for which the financial statements are being referred, or the various accounting periods for which the financial statements is being referred. So adjust financial statements if needed, calculate the financial ratios, prepare exhibits, graphs, common size statements, etc. So detailed steps over here which includes our quick review of balance sheet. Just a second. Yeah, so quick review of the balance sheet and profit and loss account. Study the historical trends. For example, the trend analysis will have to be conducted, whether it's upward trend, downward trend, or static, sidewards, what is called as. So study historical trends. Growth means upward, stagnation means consistently flat or sidewards, and decline means downward. So that's how the trends are typically identified or analyzed. Analyze the chairman's and director's reports. So a lot of information is being provided in these kind of reports which are answerable and provided and to be provided to the shareholders, etc. Identify the reporting framework. So these are the detailed steps which are involved in processing the data as the third step in this financial statement analysis framework. So continuing with the process, examine the notes, especially for the contingent liabilities. Review various accounting policies for changes and abnormalities or inconsistencies between the two accounting period or two or more accounting period. Identify business specific value drivers, example the number of stores, average order, app engagement. Check the auditor's report for any qualifications or any negative remarks, etc. if at all has been provided by the auditors, and commenting upon the financial statements per se. So these are the various data processing that one has to look into. So thereafter conduct the actual financial analysis. So this includes trend analysis, which is horizontal analysis. So horizontal means as per the horizon. So it's horizontal analysis, which is year on year. So over here, it's more of a comparative financial statement that one has to prepare or one has to analyze. So the comparison is between year on year line item comparison or 2 or more periods. So it's a side by side, 2 periods are being compared for a particular financial statement. So that's trend analysis horizontal. Then common size analysis, which is vertical. So over here, express items as percentage of the total. So in case of common size statement of profit and loss account, the base figure will be considered as the sales, total sales or revenue from operations, and then each line item will be looked into as a relationship with the total sales or total revenue from operations. So that's the second kind of a financial analysis. And third is the ratio analysis. Now over here, typically compare financial ratios over time and against peers also. So this is the processing of data. Then comes the analysis, analyze and interpret the data. So after the analysis being done, the data has been looked into, data has been processed into, notes to accounts have been seen, balance sheet have been understood, various accounting policies have been reviewed, etc. After this, one needs to draw conclusions based on the processed data and relate findings back to the original objective for which the financial statement analysis is being done. So as long as the findings are relevant to the final objective, those are to be considered, and therefore drawing conclusions and relating the findings to the original objective is essential. Then fifth step comes is the report the conclusion. So create a clear and structured report whereby the entire analysis is to be spelled out and shared with the stakeholder whoever has mandated the doing the exercise of financial statement analysis. That will be the way of communication to the outer world. So communicate findings to the intended audience. Ensure compliance with ethical and professional standards. So that's the key in terms of valuation standards. There are prescribed valuation standards in which or analysis that the way the projection has to be done to the outer world. So it has to be fair, ethical and true, and professional standards and ethics should be maintained. And last step is updating the analysis. Revisit and repeat the process regularly at frequent intervals. Revise conclusions and recommendations as may be needed. So that's the FSA framework wherein 6 steps are involved. Then comes the analysis of financial statements typically. So let's see the purpose of financial statement analysis. Why actually the financial statement analysis has to be done at all, and that purpose is typically to extract meaningful information for decision making, and commonly done using accounting ratios. So what are accounting ratios? Accounting ratios express relationship between 2 or more financial statement items. It measures performance itself of the organization, liquidity status of the organization, and solvency position also of the organization. So these are the 3 parameters predominantly which gets or the relationship which is analyzed or interpreted or meaningful information is derived in terms of performance, liquidity and solvency. Useful for inter-firm comparisons and period over period comparisons. So this is what accounting ratios are meant for, and the analysis of financial statement purpose is. Considerations for effective ratio analysis. So as we boil down to the ratio analysis as a critical aspect of financial statement analysis along with trend analysis, common size, comparative statement analysis, etc. The considerations for effective ratio analysis is ensure consistency in definitions and figures due to different accounting practices that may have been followed over a period of time, and therefore consistency has to be maintained or observed in terms of the financial statements or the accounting practices. So considerations for effective ratio analysis ensures consistency in definitions and figures due to different accounting practices. Ratios are most meaningful when used to identify trends over time. So if at all a business organization or an analyst has to look into trends over a period of time, then the ratios are considered to be the most meaningful analytical tool. Single period ratios have limited value in isolation. So if at all for a standalone period some ratio analysis being done, it will be more of a limited usage or knowledge or interpretation, and doesn't really add value being in isolation looked at the financial statements. So these are the considerations for effective ratio analysis. So in short, single period ratio should be avoided because it doesn't really value add and has a limited value in isolation. Limitations which are involved in ratio analysis are on analysis. Results depend on the quality and comparability of the financial data. So how effective the results of the ratios or the interpretation or the analysis that will be thrown by the ratios will depend on the quality and comparability of the financial data, because ratio ultimately is a relationship finding of two or more numbers vis-a-vis each other, and therefore if the financial data is authentic, complete, clear and accurate, then the financial ratios or the accounting ratios will be meaningful and interpretative. That's what it means. So therefore the results of the ratios depend on the quality and comparability of the financial data. Only provide a historical view, must be interpreted with future expectations in mind. Obviously, because the analysis is being done of the financial statements, and financial statements are always historical or past data, and therefore ratios in a way are finding the relationship of a past historical data. However, while doing so, it must be interpreted keeping the future or forecast expectations in mind always. So application wise, where does the ratio analysis in a way help, or the analysis of financial statements help, is that compare the so comparing basically the companies within the same industry, or compare different divisions within a company also. So there has to be a comparative analysis of ratios of two or more companies within the same industry, or two or more divisions within the same company. So then comes the third aspect of ratio analysis, the purpose of performance. So let's go each category wise the various ratios that are prominently used in financial statement analysis. But before that, let's understand. So as we saw, there are 3 or 4 types of key ratios or key parameters of various ratios. One is the performance, second is liquidity, third is solvency. So beginning with performance ratios, and what does typically the purpose of performance ratios is to assess a company's profitability by relating profit to various other key financial elements. So common performance ratios include return on equity, how much is the return received by a particular promoter or a shareholder on the equity that he has invested. Return on overall capital employed. Now capital employed is a larger term than equity. Then comes the net profit margin and gross profit margin. Let's see the ratios. The key performance ratios are, this is a tabular form of the, in a way, how the ratios look like. So the chart or the table which is being followed is, first column is the ratio, type of ratio in performance ratios. Then the formula per se, which is numerator and denominator. And third column is about the purpose or comment, what it reflects and what it means, or what the ratio per se, if at all to be analyzed and interpreted, what it shows. So let's understand one by one. So first is return on equity. Let me just do one thing. So unnecessary, this is bold. Just to make it more presentable, I am just so the 4 key ratios which are considered in performance, or which reflects the performance of a business organization, are given in this table, and what they mean and how they are calculated also. So let's see how return on equity is calculated. Return on equity, the formula wise is net profit after tax divided by the equity. So that's how, and what this ratio per se shows is that it shows profit earned from shareholders fund, and it is very crucial for the investors. So whoever is the equity shareholder, that equity shareholder will be always interested in how much net profit has been earned after tax paying to the government, and that's what is called as return on equity. Then comes the second ratio, which is the return on capital employed. So over here, net profit after tax divided by equity plus long-term debt. So again, because it's all about capital employed, and normally the long-term debts are used for the business purposes and not the short term ones. Short term ones are typically for the working capital requirements, and hence capital employed is something which is a long term capital, and therefore long term debts are only considered in the denominator. So over here again, net profit after tax divided by equity plus long term debt, and this typical ratio measures the profitability based on all long term capital employed. So long term debt again is a long term for longer duration of time which is invested or deployed in the business, and equity of course is for perpetual, and therefore both are long term capital employed, and therefore this ratios in a way measures profitability based on all long term capital employed and removes the capital structure impact. So that's the benefit or the purpose of this return on capital employed. Then third ratio is the net profit margin. Over here again, net profit after tax is divided by the revenue from operations. So how much is the net profit? So typical net profit margin indicates net profit made from each unit of sale after all expenses have been considered and incurred. So this is what typically how much is the profit earned from the net revenue from operations is what net profit margin is. And the fourth performance ratio is the gross profit margin. Over here gross profit is divided by revenue from operations. So in a way it shows profit after subtracting the core cost of goods sold, that is COGS, from sales. So these are the various purposes and comments of each and every ratio that we saw in terms of performance ratios. Yeah, so with this, in a way, these are the performance ratios and the four types of ratios that are normally calculated to assess the business performance or financial performance of a company or a business organization. Then comes the second parameter, which is the liquidity. So purpose of liquidity ratios, let's assess a company's ability. So as the word goes, liquidity means how a company is able to meet its short-term financial obligations, and the key ratios over here are current ratio and quick ratio. So let's see which are the quick and current ratios and what are the, so again same, more in a tabular form. The current ratios in a way yeah, so in a way current ratio is all about current assets divided by current liabilities, and it measures ability to cover short-term liabilities with short-term assets. So again, like to like matching concept is here. Current liabilities which is short-term obligation should be always matched or met through current assets, which are the short-term liquidity indicators or components, and therefore it ensures no need to sell long-term assets or raise debt for meeting the short-term obligations. That's what it means. Quick ratio again is another variant of liquidity. So over here current assets minus inventories divided by current liabilities. It's more a stricter measure of liquidity. So more aggressively it is looked at, and not necessary that every quick current asset is liquidable immediately or has a liquidity, immediate liquidity, and therefore inventories in a way are, so that's why inventories are reduced and excludes inventory to assess ability to meet obligations without relying on the stock sales. So over here the inventories obviously will need some time to realize in terms of getting sold and collecting the money. So therefore liquidity in a way is a bit less for inventories what one stricter measure of liquidity is concerned, and therefore quick ratio reduces the inventories from the current assets. and then it is calculated. So this is about liquidity ratio. Then comes the third aspect of solvency. The purpose of solvency ratios is to assess company's long-term financial stability and reliance on debt financing. So over here, how financially well stable is the long-term, company, long-term financial stability of a business organization in, and how reliance is being placed on debt financing, or how well managed the capital structure is. So in a way, the key ratios involved are debt equity ratio and the interest coverage ratio. Let's see what exactly those ratios are. So again, this is a tabular explanation of the two ratios. And how they are calculated is also again I have in a way tabulated. Yeah, so debt equity ratio, as the name suggests, is formula wise it's total debt divided by total equity. Can also use long term debt. So over here it indicates the extent of debt used to finance asset. High ratio is equal to high financial risk due to potential volatility from interest obligations. And second important solvency ratio or indicator is of about solvency is the interest coverage ratio. Over here the formula is EBIT, that is earnings before interest and tax divided by interest component. And this shows how many times a company can cover its interest payments using operating profit. Higher ratio is equal to better debt servicing ability. So obviously it shows that how much whatever interest is required to be paid or interest expense is incurred by the is being incurred by the organization. That interest expense can be made out of the earnings from the operations which have been so in a way operating profit are well sufficient enough to pay the interest expense. That's what the solvency indicators are. Then comes another category of market value ratios. So we'll see the purpose of market value ratios. Now what is the, so we saw performance ratios, solvency ratios, liquidity ratios, and then now we are seeing market value ratios. So how good the organization is in terms of the market value or the industry in which it is functioning or operating. So over here it shows the relationship between a firm's share market, market share price and its earnings or dividends. So use market value, not nominal or par value of shares for calculation. So market value basis the demand supply forces and the trading that is happening of a particular share of an organization is what is looked at. These ratios reflect the investor sentiment on a company's past performance and future potential. So in a way, because of the trading, buy and sale and demand supply activities of a particular scrip or a stock, in a way the investor sentiments about the company's performance are getting captured and getting reflected in these ratios, and also at the same time the investor sentiment about how robust and positive they feel about that particular company having a future potential, that is also assessed through these ratios. So not easily applicable to unlisted companies. Now that's a challenge in terms of these market value ratios, because it's all about market price of a particular share, and hence listed companies, for listed companies these market value ratios are easily calculatable. However, it's very difficult for unlisted companies due to lack of market determined share prices, because they are not listed on a stock exchange and hence cannot be easily traded, and buying and selling cannot be easily done so as to determine the prices. Therefore, these market value ratios cannot be easily applicable to unlisted companies. It requires share valuation before use in private unlisted firms. So in order to use these market value ratios, first and foremost for unlisted companies, the valuation will have to be conducted before using these market value ratios, commonly used to evaluate market perception, valuation and investment attractiveness. So this is what the common purpose of such ratios is, to understand the market sentiments for a particular stock or a company. Now let's see the market ratios per se. So these are the There are 4 ratios which are prominently being looked at, and let's see which are those ratios. Let me just beautify them also at the same time to make it more presentable. Yeah. So first market value ratio is the dividend yield ratio. In dividend yield ratio, obviously the dividend per share is divided by the market price per share. Now this ratio indicates return from dividends. Higher yield means may signal financial stress or payout cuts and therefore reflects investors' expectations. The second ratio is the price earnings or PE ratios, which is famously called as. Now over here it's market price per share divided by the EPS or the earning per share. Now this ratio shows how much investors are willing to pay per unit of earnings. High PE suggests growth potential but may also indicate risk. Then comes another set of ratios. Let me just again beautify that. Yeah, so price to book value. So market capitalization of a particular share divided by the book value or price per share divided by book value per share. There are 2 ways this ratio can be calculated. Let me just Yeah, so it compares market value to shareholders' equity, shows how much investors value the company above its book value. In a way, how much importance a particular shareholder is giving to a company and which is much more above its book value. That's what the price to book value ratio reflects. So in a way, the sentiment of the shareholders are getting reflected. Price to sales ratio. So again, price to sales ratio is calculated by market capitalization divided by total revenue from operations or price per share divided by the sales per share. So this is the 2 ways in which the price to sales ratio can be calculated. It measures the valuation relative to revenue, useful across sectors and less prone to manipulation than earnings based ratios. So these are the benefits or the purposes of various market value ratios. Then comes another category of ratios. So there are total 6 market value ratios. Just a second. Let me just beautify them. Yeah. So another ratio, market value ratio, is the dividend cover. Over dividend cover ratios, it's earnings per share divided by dividend per share, and indicates how many times earnings over cover dividends. Higher cover means more profits are retained for reinvestment. Dividend payout ratio is the last category of market value ratios or type of market value ratio. Typically dividend per share divided by earnings per share and shows the proportion of earnings paid out as dividends. Lower the ratios implies higher retained earnings. So these are the purposes or interpretations of the various ratios of market value. Then another parameter of ratios which are looked at are the activity ratios or the working capital ratios. Now let's understand these ratios. These ratios evaluate how effectively a company uses its assets to generate revenue. So high turnover is generally favorable, but excessive turnover without adequate working capital can lead to over trading. Used to measure management's effectiveness in using inventory, receivable, payable, and assets as such overall. That's why it's called as activity ratios or working capital ratios. How well effectiveness of the working capital of the business is all about. Let me just again beautify this. Yeah, so the inventory turnover ratios is calculated by cost of goods sold divided by average inventory, and it measures how many times inventory is sold and replaced during the year. High turnover is equal to efficient inventory management, shows how often inventory is sold during a year, and higher ratios is equal to less idle stock, less risk of obsolescence. If cost of goods sold is unavailable, then sales figure can be used. At times it's very difficult to arrive at the cost of goods sold figure, and in that situation sales figure can be used. Then another second key activity ratio is the average inventory period. So average inventory period is calculated basis the average inventory, that is opening stock plus closing stock divided by 2, that is average inventory, divided by the cost of goods sold into 365 days. So into 365 is nothing but the days of a year. Just a second. Yeah. So it indicates average days taken to turn over inventory into a sale. So shorter the period, faster the inventory turnover. So it shows in a way that if the period is short, because it's again calculated in number of days. So if the period is short, then it means that the inventory is quickly getting turn around into sales or turnover. That's what the effectiveness is getting reflected through this activity ratio, that is the average inventory period. Yeah, then comes the another set of So at times in hurriedness this beautification remains pending, and then I am just trying to simultaneously do it out. So then comes another set of activity ratio, which is creditors turnover ratios in number of days. So average creditors, again opening creditors at the start of the year and closing creditors at the end of the year, divided by 2 is the average creditors, divided by cost of goods sold into 365 days. So again the creditors turnover ratio shows average time taken to pay suppliers. So how much time it is taken by the organization to pay to the suppliers shows that how good the liquidity or good or bad the liquidity of the business organization is, how good or bad they have short-term funds available to pay off the creditors. So helps assess the payables management efficiency, reflects how many days on average the company takes to pay its suppliers. Important for managing cash flow and avoiding credit issues. So next set of ratios is the debtors turnover ratio. So in this ratio, average debtors, that is opening debtors plus closing debtors divided by 2, that's the average debtors, divided by credit sales into 365 days is how debtors turnover ratio is calculated. It measures average collection period. So shorter the period, better receivable management, and longer the period, possible liquidity risk. It reveals average time taken to collect dues from customers. Long period may indicate poor collection policies. Short may mean overly strict credit terms. So these are the key activity ratios in terms of debtors and creditors. Then moving ahead, another set of key activity ratios are the average collection period. Yeah. So average collection period. So accounts receivable into 365 divided by annual credit sales. So this ratio typically assesses the quality and efficiency of credit policy. Very short period is equal to restrictive. Very long period is equal to inefficient. Critical for judging liquidity and efficiency of the whole overall receivables management. These ratios should align with company's credit policy. Deviations may affect cash flow and profitability. So this is what the analysis is thrown upon by the average collection period, and that's why the ratios are very critical to analyze and helps analyze and interpret the financial statements as such, rather than looking just at the plain numbers. And therefore predominantly in financial statement analysis, the trend analysis and the ratio analysis are the key aspects. Then in the activity ratios, another key important ratio is the total assets turnover. Over here, sales are divided by total assets. Now this ratio indicates how efficiently all assets are used to generate sales. Higher turnover means better asset usage. It evaluates how well all assets are used to support revenue generation. Higher is generally better, but must be assessed with the profit margins. So instead of looking at just the total asset turnover ratio, if at all is high, means better asset utilization, that should not be there. It should be assessed along with the profit margins as such. Then comes the fixed asset turnover ratio again. Yeah, so fixed asset turnover ratio is sales divided by the net fixed assets. Now over here it measures how effectively fixed assets are used to generate revenue. High turnover is equal to efficient use of fixed assets. It focuses on revenue generated specifically from fixed assets, and high ratio therefore suggests effective and efficient utilization of capital intensive asset. So these are the various ratios in a way. Now let's understand another set of ratios, which is the financial leverage or gearing ratios. Now these ratios typically assess the balance between the debt and equity in financing the firm's assets. A higher portion of equity implies lower financial risk, while higher debt increases risk but may enhance returns to equity if used efficiently. And lenders and investors analyze these ratios to evaluate a firm's financial strength, risk exposure and long-term solvency. And financial leverage benefits shareholder only if return on capital is more than the interest cost. So this is the fifth parameter of ratios, or the category of ratios, that is financial leverage. Now let's see the various ratios of financial leverage. So the first and foremost is the equity ratio. Now how equity ratio is calculated is the shareholders equity divided by the total assets. So it indicates the proportion of assets financed by owners. High ratio means strong financial foundation and lower leverage risk. Reflects the portion of company's assets funded through owners' equity, expressed as a percentage. Higher the percentage, more cushion for creditors. High equity ratios means greater financial strength and lower reliance on the borrowed funds. So these are the clear-cut indications how well the financial leverage is being achieved by the business organization. Then comes the debt ratio. So debt ratio, let's see what it means. Sorry, took some time to beautify this. So in a way, debt ratio is the total debts divided by total assets, and it shows what proportion of assets is financed by debt. Higher the ratio, higher financial risk and lower flexibility in raising more debt. It indicates the degree of leverage by showing the percentage of assets funded by debt. Includes long-term debt, short-term debt and preference shares. A high debt ratio is equal to greater risk due to fixed repayment obligations and possible legal action on default. It complements the equity ratio, and how it complements is the debt equity or debt ratio is equal to 1 minus equity ratio. So over here assuming debt plus equity is equal to total assets. So this is how the debt ratio is calculated. So let's look into the way, another analytical tool of financial statement analysis, which is the capital structure analysis. So capital structure analysis means describes the mix of debt and equity used for long-term financing. It is the mix of capital or the capital structure mix which includes debt and equity used for long-term financing. A healthy capital structure maintains a balance between risk and stability. Risk is always the debt or reflected by debt. So risk is always associated by debt because it's an outside obligation which is supposed to be honored and paid back. That's why the risk is involved, because if at all a particular obligation is unable to be met by the business organization, then it could land up to insolvency or other legal complexities and disputes also. That's why it's a risk. And therefore, and stability is obviously because it's all about shareholders and the promoters only, and stability is reflected by the equity and no reliance is being put on the outside funds. That's why in a way stability of a business organization is reflected, and therefore a healthy capital structure always maintains a balance between the risk, debt and stability, that is equity. So the key ratios are debt ratio, debt equity ratio and capitalization ratio. Now this capitalization ratio is the in a way lower ratio implies stronger equity base and less risk. That's what it means. Sorry. So this is another capital structure analysis which is used in financial statement analysis. Then comes the credit analysis. Now credit analysis means what? Let's understand that. Credit analysis is the evaluation process conducted by banks, financial institutions and bond investors to assess an entity's credit worthiness, that is its ability to repay interest and principal on time. The key points are: the main goal is to eliminate the default risk of the borrower. The process includes management due diligence, verification of financial statements, tax records and legal presentations, review of credit scores, example CIBIL in India, evaluation by credit agencies, and the solvency ratios provide, just a second. Yeah, so the main goal is to estimate the default risk of the borrower. The process includes management due diligence, verification of financial statements, tax records and legal representations, review of credit scores, example CIBIL in India, evaluation by credit rating agencies. Solvency ratios provide a broad measure of financial health, and a crucial metric for credit analysis is always the debt service coverage ratio, DSCR. Now let's understand what is debt service coverage ratio. And this is how the debt service coverage ratio is calculated. So debt service coverage ratio formula is EBIT divided by short-term debt plus current portion of long-term debt plus lease payments. And the purpose of this ratio is it measures the entire entity's ability to service its debt from operating income. So interpretation wise, DSR, if more than one, is negative cash flow, not enough income to pay the obligations, and hence it's a risky situation. And DSCR, if more than one, is a positive coverage, higher is safer for lenders. So typical lender expectation about DSCR is that it should be of 5 to 6 times is considered comfortable for credit worthiness. Then comes the third analysis, that is the cash flow analysis. It focuses on the real cash that is being generated by the business. And over here there are 4 indicators. One is the operating cash flow, which should be positive always, indicates cash profits from core operations. Outstanding debtors must be low to ensure realistic sales and collection efficiency. Cash inflows from non-operating sources should be identified, may be unsustainable, example asset sale. Fourth indicator is the cash outflows, could indicate good financial decisions like debt repayment or asset investment. And fifth indicator is the operating cash flow to net sales, which measures cash generation efficiency per unit of sales. So this is how the cash flow analysis or the indicators reflect each of the purpose of the cash flow analysis. So, okay, in a way it's already 8:30. We will stop for the day, and tomorrow's session or the next session we will start with this short question and answer on this financial statement analysis as such, and thereafter we will continue with the session. So let's stop for this today's session, and see you in the next session. Thank you. Bye bye. Anu, Rakesh, any doubts, queries? Yeah. Okay, thank you. So signing off here, CACS Pushkaraj Vishnu Joshi. See you in the next session. Thank you.